Well, HDFC Limited reported a really good set of results. If I look at the Q2 performance, the net interest income witnessed a growth of about 20.7% on a YY basis, standing and coming up at about 3,647 crore rupees. Well, this was definitely above our expectations. While jumping to the profit figure, the profit after tax for Q2 stood at 2,870 crore rupees, witnessing a degrowth of 27.6% on a YY basis. Well, having said that, this was definitely above our expectations. And not just our expectations, were definitely above the street estimates as well. Well, part of this profitability was aided due to lower provisions during Q2. The provisions are down by about 42% on a YY basis and 38.6% on a sequential basis. The margins pretty much remained flattish on a YY basis. However, 20 basis points of improvement on a sequential basis. Well, this was definitely because of the fact that the funding cost did come down for HDFC, and as a result, it reflected well in terms of margin expansion. If I look at disbursements, which particularly is something that everybody is right now eyeing and looking at, the company did report good improvement on a month-on-month basis. The number of loan applications received grew by almost 12% on a YY basis, while the loan approvals witnessed an uptick of 9% compared to previous year. Well, this was something that was already indicated by the company in their Q2 FY21 updates. Disbursements were at 95% of September last year in individual loan business. Trends definitely indicated that the company and the business is reverting to pre-COVID-19 levels. This definitely is a very positive momentum and a positive direction as far as the company and the business outlook is concerned. Particularly, the press release mentions that September and October have seen strongest recovery since the outbreak of the pandemic. So it definitely indicates that on a month-on-month basis, things have been on an improving trajectory, and HDFC Limited is also well poised to capture on the kind of growth opportunities that is offered to them. Asset quality is stable, steady. Instead, there's a slight improvement. The GNPA stood at about 1.8% versus 1.87% on a sequential basis. Overall collection efficiency was also pretty much strong. For individual loans, standing at about 96.2%. Collection efficiency for non-moratorium customers stood at 99.5%. Now, coming to AUM growth. Well, the overall book grew by almost 10%. Individual loan, which comprises close to about 75% of the total AUM, witnessed a growth of 9%, while the non-individual loan book stood at 13% on AUM basis. The company assigned loans amounting to 3,026 crore rupees versus 7,160 crore rupees in the previous year to HDFC Bank via their arrangement. Well, in our interaction with KK Mistry, he mentioned that going forward, he doesn't feel the need for additional provisions given the kind of macro environment remains stable, and we do not see any resurgence of COVID-19 cases. So as of now, if things are on a similar footing, they would not require any more provisioning, given the company has adequately provided for any uncertainty that may arise due to COVID-19. So even on the asset quality front, he does not foresee much of a challenge. Let's see how the subsequent quarters pan out for HDFC Limited. Having said that, Q2 was definitely a strong show.